wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This here is the Market Color Podcast, where we keep you informed on the latest developments in the financial markets. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 166, and in this episode we are reviewing the performance of the global markets during the 26th week of 2025, and that is from Monday the 23rd to Friday the 27th of June. And without further ado, this is your host Jamhuri, and together let's dive right in. We kick it off in the United States, where, according to the latest report by the Commerce Department, consumer prices ticked higher in the month of May, pushing the annual rate of inflation slightly above expectations and further away from the Federal Reserve's target rate of 2%. The Personal Consumption Expenditures Price Index, which is the Fed's preferred measure of inflation, this rose by 0.1% for the month and by 2.3% on an annual basis, with both readings coming out in line with market expectations. However, the Core Inflation Index, which strips out volatile food and energy prices, this rose by 0.2% on a monthly basis and by 2.7% on an annual basis, which was slightly higher than the projected rates of 0.1% and 2.6% respectively. For your information, due to the volatility in food and energy prices, the Federal Reserve considers the core inflation rate as a better indicator of longer-term inflation trends. Despite the uptick in inflation, the markets remained calm, with stock futures pointing to a positive open and Treasury yields edging upwards. The Fed has been struggling to bring inflation back down to its 2% target rate since early 2021. And in other news, President Trump's war of words against the Fed chairman has taken another political turn. On Wednesday, whilst the Fed chairman Jerome Powell was testifying before the Senate Banking Committee, Trump was at the NATO summit in The Hague, where he launched his latest attack on the Fed chairman. This past week, the Federal Reserve chairman breezed through 2 congressional hearings on Capitol Hill, but now heads into a much bigger challenge, which is that President Trump could try to undermine his authority by naming his successor now, which is way in advance given that Powell's term expires in May 2026. Staying in the United States, the Federal Reserve has proposed to ease the capital rules for big Wall Street banks, a move that could free up billions of dollars but has sparked concerns about weakening financial safeguards. The rule in question is called the Enhanced Supplementary Leverage Ratio and was put in place after the 2008 financial crisis to ensure banks hold enough capital to weather economic storms. But banks have long argued that it restricts their ability to operate smoothly, especially as concerns over treasury market liquidity have increased in the recent past. Under the new proposal, big banks would see their top-tier capital requirements drop by 1.4%, which is equivalent to a reduction of about $13 billion in required capital. For the major banks, the proposal would see the required capital ratio falling from 5% to between 3.5% to 4.5%. However, at least two Fed officials have opposed the proposal, warning that loosening capital requirements could undermine financial stability. Critics argue that treating all capital the same without distinguishing between riskier and safer assets could leave banks vulnerable to another crisis. On Wall Street this past week, the stock market wrapped up the week on a high note, with the S&P 500 closing at a fresh record as it shrugged off President Trump's latest comments on trade-related matters. Stocks got an early boost after the U.S. Commerce Secretary hinted that the U.S. and China had finalized a trade framework. However, gains eased off slightly after Trump announced that he had terminated trade talks with Canada. Despite the ongoing trade wars, the stock market has staged a remarkable rebound, proving once again its ability to look past political noise. The bull market remains in place for now, but investors remain on edge as trade tensions continue to drive volatility. The key market moves were recorded by the three major indices as the S&P 500 rose by 0.52% to a new closing high of 6,173, whilst the Nasdaq Composite also reached an all-time peak, gaining by 0.5% to close at 20,273, and the Dow Jones Industrial Average jumped by 432 points to eventually close at 43,819. In the government bond market, the yield on the 10-year Treasury bond rose slightly on Friday, climbing by 2.2 basis points to 4.275%, and this was after the Fed's preferred inflation measure came in a bit hotter than expected. The Personal Consumption Expenditures Price Index, which is the Fed's go-to inflation gauge, showed an annual increase of 2.3%, and this was still above the Fed's target rate of 2%. In the meantime, the short-term yield was also up as the rate on the 2-year Treasury note rose by 2.5 basis points to settle at 3.74%. Investors are also keeping an eye on President Trump's latest attack on the Fed chairman, who has stressed that the Fed needs more time in order to assess how tariffs are affecting the U.S. economy before making any changes to monetary policy. Even a small move in Treasury yields can ripple through the markets, affecting everything from mortgage rates to stock valuations. With inflation still hovering above the target rate and political pressure bearing on the Fed chairman, investors are bracing for increased uncertainty and volatility. In the foreign exchange market, the US dollar had a roller coaster day on Friday, first sinking to multi-year lows before bouncing back after President Trump announced that he had terminated trade talks with Canada, and this sent the Canadian dollar tumbling down by 0.5% to settle at a rate of 1.37 versus the US dollar. Earlier in the day, the dollar had hit a 3.5-year low against the euro as weak U.S. economic data fueled bets that the Federal Reserve would cut interest rates sooner and more aggressively than expected. The dollar's wild ride this past week shows just how sensitive the markets are to both economic data and political comments, and how quickly trade tensions can shift currency dynamics. In the crude oil market, the oil market just had one of its worst weeks this year, even as prices ticked slightly higher on Friday. All eyes are on the OPEC meeting that is scheduled to take place on the 6th of July, and where the group is expected to approve another increase in production of up to 411,000 barrels per day, potentially adding more supply to an already oversupplied market. Meanwhile, the fear of supply disruptions resulting from the conflict between Iran and Israel, this did not materialize and caused the risk premium on oil to diminish, as the price of crude oil briefly spiked above $80 when the fighting began, but crashed down to $67 after Trump brokered a ceasefire between the two countries. The price of the global benchmark Brent crude fell by 12% this past week for its steepest drop since August 2022, and eventually came to a close at $67.77 per barrel. Meanwhile, the price of the U.S. benchmark, that is West Texas Intermediate crude, this declined by 11%, marking its worst week since March 2023, to finally settle at $65.52 per barrel. And just for your information, during the conflict between Israel and Iran, there were concerns that Iran could disrupt global oil supplies by blocking the Strait of Hormuz. So what is the Strait of Hormuz and why is it so important? The Strait of Hormuz links the Persian Gulf, which is home to massive oil reserves, to the open oceans and is just 21 miles wide at its narrowest point. The strait is the world's most critical oil choke point, with about 20 million barrels of oil passing through it every day, which is about 20% of global daily supply. In addition to that, Iran controls the northern side of the strait, giving it major leverage over global oil supplies. In the precious metals market, the price of gold took a hit, falling by 2% on Thursday to a one-month low. The sell-off in gold was driven by two main factors. The first was an announcement that the US and China had struck a trade deal to speed up the shipment of rare earth minerals. The market viewed this as a positive move towards resolving the trade tensions between the two countries. And the second reason was attributed to the ceasefire between Iran and Israel, which has reduced the level of geopolitical risk and consequently also the demand for gold, which is viewed as a safe haven asset. Gold is considered as the ultimate safe haven asset and is traditionally viewed as a hedge against inflation and economic uncertainty, and tends to perform better in a low interest rate environment since it doesn't provide a regular yield like a bond. The price of spot gold recorded its second consecutive week of losses as it dipped by nearly 3% to finally settle at $3,277 per ounce. We now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where during the past week the Kenyan shilling remained static versus the US dollar, And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.29, and this is compared to 129.28 that was recorded the previous week. Meanwhile, the sterling pound was priced at 177.17, and the euro was valued at 151.04. And on the regional front, one Kenya shilling was changing hands for 27.81 Ugandan shillings and 20.50 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.11. The Kenya shilling continues to trade within a narrow range versus the US dollar, and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves declined marginally by $26 million for a grand total of $10.88 billion, which is equivalent to 4.9 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. Please note that in its weekly bulletin, the Central Bank of Kenya does not provide any explanation for the change in foreign exchange reserves. In the money markets, during the past week, the interbank market remained sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The average interbank rate, which is the rate that banks use to lend to each other, mainly on an overnight basis, this was stable at 9.73% compared to a rate of 9.72% the previous week, and was still in line with the central bank rate at 10%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 490 million shillings, which was a massive drop from 12.9 billion shillings the previous week. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 26th of June, and the central bank received bids totaling to 14.4 billion shillings against an advertised amount of 24 billion shillings, representing a performance of about 60%. The central bank ended up accepting almost the entire amount of 14.4 billion shillings, and the results of the auction were as follows. The 91-day rate declined by 3 basis points to average out at 8.13%, whilst the 182-day rate dipped by 1.4 basis points to settle at 8.46%, and the 364-day rate slid by 1.6 basis points for an average weighted rate of 9.72%. Up next is our topical issue, and this week we're looking at the Treasury's domestic borrowing program. The National Treasury is set to close the financial year 2024-2025 with a record domestic borrowing of 815 billion shillings, and this is after an upward adjustment of the fiscal deficit via the third supplementary budget, and in addition to a shortfall in revenue collections. Successive revisions of the government's domestic borrowing target since June 2024 have raised the risk of crowding out the private sector from the credit markets, threatening the growth of the economy as banks opt for risk-free government securities instead of lending to the private sector. The Treasury is seeking approval from Parliament to increase its domestic borrowing target by about 210 billion shillings, whilst at the same time cutting its external borrowing target to 184 billion shillings. According to a report by the National Assembly's Budget and Appropriations Committee, the shift indicates a heavier reliance on the domestic market in order to finance the budget deficit, and this is on the back of tightening credit conditions in the external markets. Earlier projections from the Treasury and the Central Bank of Kenya showed that the government was already ahead of its borrowing target domestically going into June, with some analysts putting the net borrowing so far at about 800 billion shillings. In summary, for the financial year 2024-2025, the government is on track to borrow a record amount of 815 billion shillings from the domestic market. This is the direct result of a wider budget deficit caused by lower than expected revenues and higher expenditure, and coupled with tight credit conditions for foreign loans. The government's over-reliance on the domestic market to fund its budget deficit is likely to crowd out the private sector, and this in turn could lead to slower economic growth. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. For more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcast, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamuhuri@gmail.com. Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, the future belongs to those who believe in the beauty of their dreams. Think about it. Thank you, and God bless.